Well, there's not necessarily much investors are agreeing on this year, but a lot of people are looking to the fixed income market as having a comeback in 2023. PIMCO Managing Director and Portfolio Manager Sonali Pier joined us now to discuss. Sonali, this has been one of the refrains that we have been hearing from investors. Why are people feeling so good about the bond market for this year?
Yeah, absolutely. After a tough 2022, it really has changed the landscape where yields are today. Of course, on the back of the Fed hiking rates. And, today, if you look at the yields, even on 10-year treasuries, for example, there's positive yields. There wasn't long ago we were talking about the stock of negative yielding assets. Today, not only have yields improved dramatically, but there's also providing a fair amount of income. So despite potential volatility in 2022, there's a lot of room now, 2023, a lot of room now for income producing assets. And as you look out the curve, even out to credit markets, we can pick up even additional yield.
And you believe that the bulk of the Fed rate increases is behind us? And I mean, largely, we would all hope that it certainly is, given the kind of extent that they did raise last year. But what would that volatility that you were mentioning, what would that really hinge on in terms of their tenor and any type of rate increases that they continue to move forward with?
Yeah, so from a Fed perspective, we do think the bulk of the move is behind us, but yet volatility is likely to stay, and part of that has to do with the recession probability. Our base case is that we would likely see a mild recession, but one that's longer and shallower than, say, what we saw in the V-shaped recession and recovery in 2020. As a result, there's still a lot of volatility potential from an employment perspective as well as from a growth perspective.
In a recession, what areas of the corporate bond market do you think would get hit this year?
Yeah, where we're most concerned, even though if you look at the public credit markets, there has been a fair amount of improvement on the back of, the 2020 peak pandemic experience being rather recent. Many companies have raised a lot of debt, in the back half of 2020 and in 2021 to help weather that storm. But where we're most concerned really has to do with areas where there's low multiples on those businesses, low margins, high cyclicality, where it's very difficult to weather a storm like a recession when you have those types of things against you, as well as still inflation.
Sounds like retail.
Impact.
Retail is a big
Retail would be one, autos, wirelines, some areas where you're just continuing to see declines, even some slow, some faster, but due to a shift in investor demand as well as disruption from the supply chain.
So it sounds like even though you want to get your yield right now, you don't want to take on too much risk in order to get that yield. Is that fair to say?
I think that's absolutely right. Where we're looking at opportunities really is because that fixed income has really repriced. But knowing that there's potential volatility ahead, it's really doing it for a long-term hold or for, kind of scaling in at these higher yields for that income producing aspect of fixed income, as well as the fact that it will be less volatile typically in a recession than equities. So, you're getting some cash flow along the way, and then you're subduing some of that volatility relative to equity markets in a recession. So looking at investment grade, high quality parts of high yield, rather than, say, distress just yet.
Mm-hmm. For investors that are just looking to find confidence coming out of 2022 and moving on into 2023 here, in their portfolio, where could they position or at least find one of those sources of confidence in the markets?
Yeah, I think areas that we believe that, even if you look at it from a long-term history of percentile of spreads, and you look at, the low probability of default. So, for example, a sweet spot may be those triple Bs within investment grade, for example, where, dollar prices have come down a lot as a result of interest rates rising, as well as credit spreads having widened. But again, we're looking at this as an opportunity in more of the defensive sectors, a longer-term hold, where, we do still expect that volatility in at least the first half of 2023, if not throughout.
Sonali, thanks so much. It's a really interesting time. People are not used to seeing yields like this, so some definite opportunities out there. Sonali Pier of PIMCO, thank you. Appreciate it.
Thank you.